Okay, cool. We're taking this exam where we are basically taking this exam on weighted average cost of capital. Now it says the concept of risk premium in the context of the capital asset pricing model. So we have the risk premium is beta minus government bonds. The risk premium is the return on government bonds seen through the lens of dirt. No, risk premium is the additional return expected for taking equity risk over risk-free assets. That's the correct answer. Yep. Is the additional taking equity risk over the risk free? Yeah, it is. Yeah, it's the equity risk premium. That is the equity risk premium. Yep. Okay. Differentiate between the cost of debt and the cost of equity in the context of the WACC. Okay. Cost of debt is the return required by equity investors. Well, that doesn't make no sense at all. The cost of debt is the effective interest rate paid on borrowed funds adjusted for tax savings. The cost of debt is the cost of debt is the effective interest rate paid on borrowed funds adjusted for tax savings. That is correct. This is the cost of debt and the cost of equity. Okay. The cost of equity is the interest rate paid on borrowed funds. The cost of debt is the effective interest rate paid on borrowed funds, while the cost of equity is the return required by equity investors. Okay, that's the right answer. Describe how the target capital structure is found in WACC calculations. Target capital structure is based on historical funding proportions. Target capital structure is determined by analyzing the capital structure of mature companies in the same industry. Target structure, and I'm reading from bottom up this time, guys. A target capital structure reflects the company's current debt equity proportions. Capital structure is based on funding proportion the last 2 years. Well, the first two are no, for sure. Target is based on historical funding proportions. No, it's this one. Target capital structure is determined by analyzing the capital structure of mature companies in the same industry. That's the right answer. Identify the process of deleveraging and releveraging beta in the context of the capital asset pricing model. So at the top, it says releveraging beta adjusts the unlevered beta to reflect the company's target debt to equity ratio. Releveraging beta removes the effect of op risk to reflect that no. Relevering beta involves reducing the debt to equity ratio. No. Deleveraging beta involves increasing the debt. No. Yep, it's adjusts the unlevered beta to reflect the company's target. Adjust the unlevered beta to reflect the company's target debt to equity ratio. That is correct. Identify the components needed to calculate the cost of equity using the capital asset pricing model. You've got the market risk premium, beta, and the cost of debt. No. The risk-free rate, yes. Expected market return and beta. Cost of equity, cost of debt, and the tax rate, risk-free rate, market risk premium, and the tax rate. It's this one. It's the capital asset pricing model formula is the risk-free rate plus the market risk premium times beta. Determine the relationship between beta, the cost of equity, and the cap asset, and the CAPM. Okay, so you got a lower beta increases the cost of equity. Beta has no impact on the cost of equity. Higher beta stabilizes the cost of equity. High beta indicates higher risk and therefore higher cost of equity. It's the last one. Why? Because, well, if you've got a beta, let's say 1.5, and the market moves up 10 points, well, then that particular stock's going to move up 15 points. So it's more volatile. And so the higher the beta, the more volatile the stock is. The average industry unlevered beta for the following group of companies. Okay, let's do that. Average industry unlevered beta. Let's copy this data. Let's bring this over Excel sheet. And then let's go to work. Okay, so this is what we're working with here, guys. This is levered beta. We want unlevered beta. Sorry, guys, I had a phone call come in, but let's finish the unlevered beta. So unlevered beta is you take levered beta and, pretty much whenever you're unraveling anything, right, you want to divide it by something. We're going to divide it by 1 plus the inverse of the marginal tax rate, or the difference between that and 1. And we're going to multiply it by the target capital structure, or the existing capital structure. And there you go. And then we're going to bring that down. And then we're going to take the average of all the unlevered betas, and we get 1.44. And that's how we got there. Okay, next. Differentiate between the current and target capital structure in the context of a weighted average cost of capital. So you've got the target structure is based on historical. No. Current capital structure reflects the company's existing debt and equity proportions. Yes, that's correct. The current capital structure is used for long-term projections. No. Current capital structure is based on future funding. No, it's this one. Current capital structure reflects the company's existing debt and equity proportions. So determine the impact of the WACC on a company's valuation. Okay, higher WACC increases the present value of the future cash flows? No. Higher WACC decreases the present value of future cash flows, thereby reducing the company's valuation. That is correct. Why? Well, because it's literally the cost of borrowing and the cost of you got to return to the investors, and if they want more, well, the WACC is higher, well, then there's more risk. And if there's more risk, it's less valuable because assets or cash flows that are less risky are more valuable. Okay, so assess the importance of using current market values and WACC calculations. Using current market values prevents WACC from reflecting the most current up-to-date, blah, blah, I don't know why I said it. Current market values are irrelevant to most parts of it. Using current market values ensure that the WACC reflects the most accurate up-to-date cost of capital. Current market values are only important when there is significant volatility in the current market. Okay, current market values and WACC calculations. Well, I guess ensures that the WACC reflects the most accurate up-to-date cost of capital structure. Select the method not used to determine the risk premium in the capital asset pricing model. Not used to determine the risk premium. Okay. Obtaining the premium from a specialist data provider. You can do that using the current interest rate on corporate bonds, using implied returns based on future expectations, using historical average of returns over a period of time. So yes, you can do the last one. Implied returns based on future expectations. You can do that too. Current interest rates of current corporate bonds. I don't. Why would you do that for equity? Yeah, bonds is debt. Calculate the WACC. Okay, so let's take this data. Some people call it data. Some people call it data. I'm gonna call it data because I want a data. All right, here we go. All right, let's do the WACC. So you've got the cost of debt pre-tax. We want the after-tax cost of debt. What's wrong with me? We want the after-tax cost of debt, right? Okay, then we've already got the cost of equity. Okay. Then you've got debt, and you always want to use the market value. You never want to use the book value. So what we want to do is we want to sum the market. Oh, yikes. We want to sum the market value of equity and the market value of debt, right? And then we want to get the, because this would basically be the target capital structure. And what this does is it gives us the proportion of debt and equity in the capital structure. So now this is after tax cost of debt. You already got the cost of equity, and then you got the proportions of equity and debt. So this is equity, right? And this is debt. So now we simply take the cost of debt, multiply it by the debt in the capital structure, plus the cost of equity and the proportion of equity in the capital structure. And that's the WACC, 5%. I'm only a C student, y'all. Beta. All right, let's unlevered beta. Well, we already know what the formula for unlevered beta is, so we just got to work it out, okay? So we've got the levered beta, start there. Then we want to delever it. So it's a division problem. Okay, 1 plus 1 minus the marginal tax rate times the existing debt to equity ratio. So that is the debt in the existing capital structure divided by the equity in the existing capital structure. 3.17. And we know that's correct because it's coming down. And it's 177, so rounding up to 3.18. And then we're going to calculate the WACC for the below company to one decimal place. For the company to one decimal place. Okay. Now let's calculate the weighted average cost of capital to one decimal place. Okay, so the after-tax cost of debt is 1 minus the marginal tax rate. And so that's the after-tax cost of debt. And then we got the cost of equity is right here. It's not an issue. We got the equity. All right, so this is the trick. They're trying to trick you by giving you the book value, but we're smart people, so we know we got to use the market value. Okay, so let's just sum the total capital structure right here, total capital structure. And then we get the equity proportion and the debt proportion of the target capital structure here. And then it's a simple multiply the cost of equity times the proportion of equity plus the cost of debt times the proportion of debt. And there you go, 9%. Okay, 15. Calculate the weighted average cost of capital for the below company to one decimal place. Okie dokie. They're going to try to trip us up by giving us a whole bunch of information and saying if we know how to use it. Oh, I see what they want us to do. They want us to lever beta first. And so because we're levering it, it's a multiplication problem, but all else is the same regarding the formula. So we want to relever beta times and because we're relevering it, or we're going to lever beta, we use the market value. We want to do the target debt to equity ratio. Debt to equity. Oh, you see what they did there? Oh, they're so slick. They wanted us to first we have to calculate the equity, market equity, which is the market cap. So the market value of equity is what we've got, the fully diluted number of shares outstanding times the share price. All right, there we go. All right, now we got equity. Okay, now let's relever beta. So we got unlevered beta times 1 minus the 1 plus 1 minus the marginal tax rate times the debt to equity ratio, which is where's the book value of debt, market value of debt to market value of equity ratio. Cool. Debt to equity ratio. All right, good to go. And you see beta, it went up. Beta went up. Leverage went up because we're levering it. We're adding leverage. Financial leverage. Financial leverage magnifies returns. Okay. Now let's figure out the cost of equity. The cost of equity is, let's see here, the risk-free rate, which is, it could be like a 10-year treasury bond. And then what we do is we say it's the risk-free rate plus the market risk premium times beta. And that's the cost of equity. And this is beta. And then we've got it says corporate bond spread over the risk-free rate for company with comparable credit rating. Corporate spread, bond spread over the risk-free rate. Okay. So they want me to get the cost of debt. So, okay, corporate bond spread over the risk-free rate for a company with comparable credit rating. Okay, got it. So let's add the corporate bond spread over the risk-free rate, and then let's multiply that by the after-tax cost of debt. All right, let's turn it into the after-tax cost of debt. So now this is the after-tax cost of debt. Okay, now we got the cost of equity and the after-tax cost of debt. And we also have the market cap and the market value of debt. Now let's add those two things together. Market cap, market value of debt. Okay, that's EV. Okay, now we've got the capital structure laid out. Now it's just a function of, we can take let's figure out the percentage of it. So, oh, whoops, wrong one. All right, so this is the market value of outstanding debt right here. This is the proportion of it to the actual capital structure. Same thing with equity. There you go. And then we know that this is the total cap because if you add these two together, it's 100. There you go. All right, we did that right. Now we can multiply the debt times the cost of debt plus the equity proportion times the cost of equity, and bam, that's the WACC, 7.2. All right, we're going to calculate the WACC again. Okay, so we got the cost of debt pre-tax. We want to change this to the after-tax cost of debt. You know what that is. We multiply it by 1 minus the tax rate. We got the cost of equity here. We got the market. We got the debt. We got the book value of debt, which we're going to ignore. We got the market value of equity, which we want. This is so we add the market value of equity and we also add debt. Now we've got the total capital structure / EV. Okay, now in terms of proportionality, market value of equity divided by the total capital structure. Then we've got the debt proportionate to the total capital structure, and now we simply take the weighted average of the debt times the after-tax cost of debt, and we add that to the cost of equity times the proportion of equity in the capital structure, and we've got a weighted average cost of capital of 11.1%. Okay, so determine the impact of a higher beta on the cost of equity. Well, it creates volatility in the return on capital employed. It increases the cost of equity, higher beta. Well, let's just say, because I think this is talking about debt too, and we're only talking about equity. And yes, it does increase volatility, but only on equity and not debt. So it increases the cost of equity is what a higher beta does. That's the role of peer group analysis in determining the target capital structure. Okay, peer group analysis is used to calculate the cost of equity. Well, yeah, that's true. Yeah. Peer group analysis provides guidance on the expected long-term capital structure based on industry standards. That is the correct answer, though, that they're looking for. And then it says the analysis helps identify short to no, it's long term, and it's irrelevant. No, that's not correct. So we had the right answer. Select the statement that best describes a discounted cash flow technique. A method to calculate future cash flows based on current market trends, a technique to estimate the future value of an investment, formula to calculate the cost of debt, a method that takes a cash flow occurring in the future and calculates how much would be paid for today. Yep, that's the right answer right here, because we're actually present valuing the future value. That's what the DCF does. And now we want to relever beta. And again, guys, look, I'm only a C student, but we'll see what grade we get. Okay. So we've got unlevered beta, blah blah blah. What we want to relever beta? Okay, relever beta. Okay, so we got the unlevered beta. We want to lever it up. So that's 1 plus, 1 minus tax rate. And then we want to multiply it by the target capital structure debt to equity. And it's 1.5. Okay, we're satisfied. Let's see what grade we get. Oh, we got a 100%. Yeah, let's go on our first attempt. And this was the weighted average cost of capital continuing professional education credit. And they say you must complete the qualified assessment within 1 year of enrollment to receive the certificate. You need to pass at least 70%. Blah blah blah. Okay, that's good. That's good. That's good, guys. We did it. We did a good job. Well done. You have passed. Yay! All right, let's look at our certificate. WACC analysis. WACC analysis claim certificate. Yay! All right, let's take a look at our certificate for the WACC review certificate. Oh no, sorry. Back. Scroll back like a butt crack. Certificate. Yeah, look at that. Financial edge training. Yeah.